America just crossed a line that should terrify every citizen. On November 21st, 2024, the United States national debt officially surpassed $36 trillion. That's not a typo. 36 trillion. A number so massive that your brain can't even process what it means. But here's what should keep you awake at night. We didn't stumble into this milestone. We sprinted toward it. In just 1 year, America borrowed over $2 trillion. That's $6 billion every single day. $71,000 every second. While you've been sleeping, working, living your life, your government has been writing checks that your children and grandchildren will spend their entire lives trying to pay. This isn't just another big number. This is the moment historians will mark as the point of no return. Every empire tells itself the same lie, that their money is different, that their debt doesn't matter, that they can borrow forever without consequence. Rome believed it when they started diluting their silver coins. France believed it when they printed assignats during the Revolution. Germany believed it in the 1920s, and every single time, reality arrives like a sledgehammer to the face. The difference is that when America's debt bomb explodes, it won't just destroy one country. It will shatter the entire global financial system. Because unlike those historical collapses, the whole world now runs on dollars, trades in dollars, and trusts in American promises. When that trust breaks, there's nowhere left to hide. But before we dive into what this means for your savings, your job, and your future, let me show you just how insane this acceleration has become. We started 2024 by crossing $34 trillion. By summer, we hit $35 trillion. Now we're staring at $36 trillion as we head into the holidays. It took America over 200 years to rack up its first $1 trillion of debt. It now takes us less than 4 months to add another trillion. The pace isn't slowing down, it's accelerating. And that acceleration is what makes this different from every other debt crisis in history. Here's the part that should make your blood run cold. This explosion in borrowing isn't happening during a war, a pandemic, or an economic collapse. It's happening during what economists call favorable conditions. GDP growth has been well above the 15-year average. Unemployment is low. The stock market keeps hitting records. And yet, despite this supposedly strong economy, the government is borrowing money faster than any time in peacetime history. When empires start borrowing frantically during good times, it means the good times are an illusion built on borrowed money. And when the borrowing stops, the illusion collapses. The debt to GDP ratio tells an even more terrifying story. Right now, America owes more than 120% of everything the entire country produces in a year. Think about that. If every single dollar generated by every business, every worker, every transaction in America was seized by the government, it still wouldn't be enough to pay off the debt. We crossed 100% debt to GDP back in 2013. In just over a decade, we've added 20 percentage points to that ratio. The Congressional Budget Office projects that by 2034, debt will reach 116% of GDP. By 2055, it will hit 156%. That's not a projection. That's a death sentence for the American economy. But ratios and percentages don't capture the real horror. The real horror is what this debt costs every single day. In 2024, the United States government spent $881 billion just on interest payments. Not on roads, not on schools, not on defense. Just interest. Pure tribute paid to bondholders for the privilege of staying afloat. That's more than the government spends on Medicare, more than national defense. 1 in every $5 the government spends now goes to interest payments instead of anything that might actually benefit the American people. And those payments are accelerating at a pace that should make every taxpayer furious. Let me put this in perspective. In 2015, interest payments were $223 billion. By 2020, they had grown to $345 billion. In just 4 years, they've nearly tripled to $881 billion. The Treasury now pays $2.6 billion per day, on average, just to service existing debt. By 2035, that daily tribute will rise to $4.9 billion, every single day, forever. Unless something changes, and something always changes when numbers get this insane. The reason interest costs are exploding isn't just because we owe more money, it's because the cost of borrowing money has skyrocketed. When the Federal Reserve was fighting post-pandemic inflation, they jacked up interest rates to levels not seen in over 20 years. The federal funds rate went from near 0 to 5.5%. Treasury yields, which determine what the government pays to borrow, jumped from less than 1% during the pandemic to over 4% today. And here's the kicker. 30% of all outstanding debt, about $6.7 trillion, will mature and need to be refinanced within the next 3 years. That means the government will have to borrow that money all over again at these much higher rates. This is where the math becomes impossible to ignore. When you're borrowing trillions of dollars and interest rates double or triple, the cost doesn't just go up, it explodes exponentially. Over the next decade, the government will spend $13.8 trillion just on interest payments. That's more than the total interest paid over the past 2 decades, adjusted for inflation. By 2026, annual interest costs will top $1 trillion. By 2035, they'll reach nearly $1.8 trillion. At that point, the government will be spending more on interest than Social Security, more than defense, more than everything except the interest itself. Historical context makes this even more terrifying. Interest payments as a percentage of GDP haven't exceeded 3.2% since World War II. We're already at 3.1% and rising fast. The Congressional Budget Office projects will exceed that historical ceiling every year from 2025 to 2034. The ratio of interest payments to tax receipts hit 36.3% in the second quarter of 2024. That's the highest since 1997, and it's climbing. Soon, more than half of everything the government collects in taxes will go to interest payments. Not to services, not to infrastructure, not to anything productive, just interest on money already spent. Some people point to Japan as proof that massive debt doesn't matter. Japan's debt to GDP ratio is over 230%, and they haven't collapsed. But Japan's situation is completely different, and even Japan is starting to crack. Japan owns most of its own debt through domestic institutions and their central bank. The Bank of Japan holds nearly half of all government debt, and domestic insurance companies and banks hold most of the rest. Japan essentially lends money to itself at artificially low rates. America doesn't have that luxury. Foreign governments and institutions hold trillions of dollars in US debt. China, Japan, and other countries can dump their treasury holdings anytime they lose confidence in American fiscal policy. When they do, interest rates will spike, and the debt spiral will accelerate beyond control. Even Japan's model is breaking down. Recent analysis suggests that if Japan lets yields rise to defend their currency, it could trigger a debt crisis. Economists are warning that Japan's low-rate approach isn't sustainable without financial repression, and a debt crisis is much closer than people think. If Japan, with all their advantages, is approaching a breaking point, what does that say about America's trajectory? The political reality makes everything worse. The federal government just crossed $36 trillion as policymakers face a host of fiscal deadlines in 2025. Tax cuts are expiring, budget caps are ending, and another debt ceiling fight is looming. The incoming administration wants to extend tax cuts that will add trillions more to the debt. Neither major party is focused on the deficit. The last balanced budget was during the Clinton years, over 2 decades ago. Every proposal to cut spending faces political opposition. Every suggestion to raise taxes gets shot down. The machine is designed to spend, borrow, and kick the problem to future generations. But future generations are running out. The math is approaching a point where no amount of economic growth, no amount of tax increases, and no amount of spending cuts can fix the problem without massive pain for ordinary Americans. We're not just approaching the point of no return. We may have already crossed it. The consequences of this debt explosion will hit ordinary Americans in ways most people haven't even considered. When economists talk about debt crowding out government spending, they're describing something brutal and immediate. Money that should go to fixing crumbling infrastructure, upgrading schools, or strengthening national defense is instead flowing to bondholders as interest payments. The government becomes a massive wealth transfer machine, taking money from taxpayers and handing it to investors who own treasury bonds. Many of those investors aren't even Americans. Foreign holders of US debt collect billions in interest payments every year, money that flows out of the American economy forever. The crowding out effect is already visible if you know where to look. Federal spending on children fell below interest payments for the first time in 2024. Roads are deteriorating, bridges are failing, and the electric grid is aging. But there's always money for bondholders. This isn't an accident. It's the predictable result of a system that prioritizes debt service over everything else. And as interest costs continue climbing, the squeeze will get tighter. Essential services will be cut, taxes will rise, or both. There's no fourth option when mathematics takes over from politics. But the real devastation will come when foreign creditors lose confidence in American fiscal responsibility. The United States enjoys a unique privilege in the global financial system. The dollar is the world's reserve currency, which means other countries need dollars to trade with each other. This creates artificial demand for US debt because foreign central banks need somewhere safe to park their dollar reserves. Treasury bonds have been that safe haven for decades, but safety is a perception, not a guarantee, and perceptions can change overnight. China holds over $1 trillion in US Treasury bonds. Japan holds another trillion. These aren't investments in American success. They're strategic positions that can be weaponized. If these major creditors start selling their treasury holdings, it will trigger a cascade that makes 2008 look like a minor correction. Interest rates would spike as the government desperately tries to attract new buyers for its debt. Higher rates would make the debt burden even more crushing, forcing even more borrowing to cover interest payments. The spiral would feed on itself until something breaks. The historical precedent is clear and terrifying. Every major empire that reached this level of debt relative to its economy faced the same choice: inflate the debt away or face financial collapse. Rome chose inflation by debasing their currency. France chose inflation by printing assignats. Germany chose inflation in the 1920s and again after World War II. In every case, the result was the same. Ordinary people saw their savings wiped out while elites protected themselves with real assets. The currency became worthless, trade networks collapsed, and social order broke down. America faces the same choice today, but the stakes are global. If the Federal Reserve tries to inflate away the debt by printing trillions more dollars, it won't just destroy American savers. It will undermine the entire international monetary system built around the dollar. Other countries will abandon dollar-based trade, central banks will dump their treasury holdings, and the United States will lose the privilege that has allowed it to borrow so recklessly for so long. The transition would be chaotic, violent, and impoverishing for hundreds of millions of Americans who have never imagined life without the dollar's global dominance. The alternative is equally grim. If the government tries to maintain fiscal discipline by cutting spending and raising taxes, the economy will contract sharply. Unemployment will soar, tax revenues will fall, and the debt to GDP ratio will get worse even as the government tries to improve it. This is the deflationary trap that has destroyed countless economies throughout history. There's no gentle landing when debt levels reach this extreme. The choice is between controlled demolition and uncontrolled collapse. Recent events suggest which path America is choosing. Despite growing debt and rising interest costs, there's been no serious attempt to reduce spending. The incoming administration is promising tax cuts that will add trillions more to the debt. Proposals for spending cuts face immediate political opposition from every affected constituency. The Federal Reserve has already shown its willingness to print money to solve fiscal problems, and they'll likely do it again when the crisis accelerates. The setup for massive inflation is already in place. Smart money is already positioning for this outcome. Wealthy individuals and institutions are moving capital into assets that hold value when currencies collapse. Real estate, commodities, precious metals, and foreign assets offer protection that paper dollars cannot provide. Meanwhile, ordinary Americans continue holding their wealth in bank accounts, retirement funds, and other dollar-denominated assets that will be wiped out when the inflation arrives. The wealth transfer from the bottom and middle to the top will be staggering, just as it has been in every other currency crisis throughout history. The timeline for this crisis is accelerating. When debt grows faster than the economy, when interest costs consume an ever larger share of government revenue, when political solutions become impossible, mathematics takes over. The Congressional Budget Office's projections assume current trends continue unchanged, but current trends are unsustainable. Something will break long before debt reaches 156% of GDP in 2055. The break could come next year if foreign creditors lose confidence. It could come in 5 years when interest costs top $1 trillion annually. It could come tomorrow if a geopolitical crisis triggers a flight from dollar assets. What makes this moment different from previous debt crises is the scale and interconnectedness of the global financial system. When Argentina defaulted on its debt in 2001, it was a regional crisis. When Greece nearly collapsed in 2010, it threatened Europe but not the world. When the United States reaches its breaking point, there will be nowhere to hide. Every major economy depends on dollar-based trade. Every central bank holds treasury bonds. Every multinational corporation has dollar exposure. The collapse of American fiscal credibility will reverberate through every market, every currency, and every economy on Earth. The $36 trillion milestone isn't just a number. It's a warning signal that time is running out. Every day the debt grows larger. Every month interest costs climb higher. Every year the mathematics get more impossible to solve. The point of no return isn't some distant theoretical concept. It's approaching fast, and most Americans have no idea what's coming. The signs of approaching collapse are already visible for those who know where to look. Interest payments have become the government's second largest expense, surpassing everything except Social Security. Veterans' benefits, education, transportation, infrastructure, all of these combined cost less than what America pays just to service its existing debt. The government now spends more on interest than it does on all programs for children. Let that sink in. The future generation that will inherit this debt receives less government investment than bondholders who profit from that same debt. This isn't just bad policy, it's a preview of what's coming. As interest costs continue climbing, they will crowd out more and more essential spending. Roads will crumble while bondholders get paid, schools will close while interest checks get mailed, hospitals will shut down while foreign creditors collect their tribute. The government becomes a massive extraction machine, pulling wealth from productive Americans and transferring it to investors who contribute nothing to the real economy. The most dangerous part of this trajectory is how quickly it can accelerate. Debt crises don't unfold gradually, they explode without warning when confidence breaks. One day, treasury bonds are the safest investment in the world. The next day, nobody wants to own them at any price. The transition happens in hours, not years, and when it starts, there's no stopping it. Look at what happened to Britain in 2022 when Prime Minister Liz Truss announced unfunded tax cuts. Within days, the bond market revolted, interest rates on government debt spiked, pension funds faced margin calls, and the entire financial system teetered on collapse. The Bank of England was forced to intervene with emergency bond purchases, and Truss was driven from office within weeks. That was just a preview of what awaits any government that loses the confidence of its creditors. Britain's debt was manageable compared to America's current situation. When the bond vigilantes turn their attention to US Treasuries, the carnage will be spectacular. The Federal Reserve's response to the next crisis is already predetermined. They will print money, lots of money. They have no choice. When interest rates spike and the government can't afford to service its debt, the Fed will buy Treasury bonds with newly created dollars. They'll call it quantitative easing or some other technical term, but it's really just monetizing the debt, turning government IOUs into currency, creating dollars out of thin air to pay the bills. This isn't speculation. It's exactly what happened in 2020 when the pandemic struck. The Fed's balance sheet exploded from $4 trillion to $9 trillion in a matter of months. They bought treasury bonds, corporate bonds, mortgage securities, and anything else that needed a buyer. The money printer ran so hot that inflation reached levels not seen in 40 years. And that was during a temporary crisis. The coming debt crisis won't be temporary, it will be permanent. When the Fed starts printing trillions to keep the government solvent, the dollar will lose purchasing power at a pace that will shock Americans who have never experienced real inflation. Prices will rise not by percentages, but by multiples. A gallon of milk that costs $5 today could cost $50 within years. A modest home that sells for $300,000 could be worth $3 million in inflated dollars. Salaries will lag behind price increases, wiping out the middle class and turning America into a nation of the ultra-rich and the desperately poor. The wealthy understand this dynamic and are already protecting themselves. They're buying real estate, precious metals, art, and other assets that hold value when currencies collapse. They're moving money offshore, acquiring foreign citizenship, and building wealth outside the dollar system. Meanwhile, teachers, nurses, mechanics, and millions of other working Americans keep their savings in bank accounts that will be worthless when the inflation arrives. This wealth transfer isn't accidental. It's how every debt crisis ends. The government creates money to pay its bills, prices skyrocket, and people with assets get richer while people with cash get wiped out. It happened in Weimar Germany, where factory owners became billionaires while workers needed wheelbarrows to carry their wages. It happened in Zimbabwe, where farmers who owned land survived while city dwellers starved. It's happening in Turkey, Argentina, and Venezuela right now, and it will happen in America when the mathematics finally overwhelm the politics. The international implications make this crisis even more dangerous. The dollar's role as the global reserve currency means that American inflation becomes world inflation. When the Fed prints money to buy treasury bonds, those dollars flow throughout the global economy, driving up prices everywhere. Countries that have built their economies around dollar-based trade will face devastating choices. They can continue accepting depreciating dollars and watch their purchasing power evaporate, or they can abandon the dollar system and risk economic chaos during the transition. China and Russia are already building alternative payment systems designed to bypass the dollar. The BRICS nations are discussing a commodity-backed currency that could challenge American monetary dominance. Central banks around the world are quietly reducing their treasury holdings and buying gold instead. These aren't random policy decisions. They're preparations for the end of the dollar era. When that end comes, Americans will discover how much their standard of living depended on the rest of the world accepting their currency. Imports will become prohibitively expensive. Foreign travel will be impossible for most people. The military will struggle to maintain overseas bases when other countries refuse dollar payments. America will face the same constraints as every other debtor nation throughout history. The political system is completely unprepared for this reality. Politicians continue promising more spending, lower taxes, and endless growth, as if the laws of mathematics don't apply to America. Both parties participate in this delusion because telling the truth would be political suicide. No candidate can win by explaining that Americans must choose between massive spending cuts, crushing tax increases, or currency collapse, so they don't explain it. They pretend the debt doesn't matter until the day it suddenly matters more than anything else. The $36 trillion debt isn't just a number. It's a countdown timer to financial catastrophe. History shows us that no empire survives when debt spirals out of control, and America is sprinting toward that same cliff. The math is simple, the politics are impossible, and time is running out. Protect yourself now, because when this system breaks, it won't ask permission.